Consumer prices in Australia added 0.4% in the second quarter of 2013 compared to the previous 3 months, marking a 2.4% gain on a yearly basis. Zoë McHugh, interest rate strategist at ANZ, is on the phone with me now to discuss how today's figures could impact the Reserve Bank of Australia's interest rate strategy. Zoe, firstly, looking at today's data itself, can you briefly expand on this figure for us, and what have the drivers been?
Yeah, Natalie, that was headline CPI, which was broadly in line with the market's expectations. The major upside surprises were in clothing and footwear and furniture, with some reversal of the first quarter's aggressive discounting and perhaps some signs of a clawing back of margins. Rents were also higher despite reports of higher vacancy rates. And we also saw some upside surprise in house purchase costs and tobacco. Offsetting some of these gains were fruit and vegetables, which surprised on the downside, and there were some strong seasonal falls in domestic travel and fuel, although these were largely as anticipated. Core inflation actually surprised the market with a 0.6% quarter-on-quarter print for the average of the RBA's two preferred statistical measures, from 0.4% quarter-on-quarter in Q1. And the interest rate market looks to core inflation for guidance on the RBA and the direction of term rates. And with expectations of a weaker print priced in, these results surprised the market a little.
Markets will now be watching for how the RBA responds. A 65% chance of the central bank cutting the cash rate from 2.75% to 2.5% had previously been priced in. However, if we look historically at inflation on non-tradable products, currently standing in excess of 4%, similar performance in 2007-2008 sparked a hike in rates from the RBA. Whilst the currency picture is different, what can we expect from the central bank now in terms of interest rates?
Yes, the market moved to cut the chances of an August rate cut to around 54% after the print, although this has gradually drifted back up to around similar pricing just before the CPI came out, following the weaker China HSBC PMI, which came out shortly after the CPI data. The possibility of a late August federal election in Australia is also a complicating factor for a timing of another RBA cut. Non-tradable inflation does remain relatively strong at around 4% year-on-year, and we still expect this to ease in line with signs of rising spare capacity in the economy. But it also means that a rate cut in August is not conclusive. Tradables inflation remains subdued at around minus 0.6% year-on-year. The falling AUD will obviously put upward pressure on this component of inflation, but pass-through is fairly slow and protracted. As such, ANZ continues to expect a further rate cut sometime later this year as the economy manages the transition away from mining-led growth.
The Reserve Bank of Australia last week commented that there were increasing signs that record low interest rates were starting to spur key areas of the economy, like housing construction and consumer spending. Would you agree?
Yes, I do, Natalie. There are signs that interest rate-sensitive parts of the economy are responding to recent rate cuts from the RBA, and housing is one of those components, and the housing market has been improving this year. In fact, this showed up in the CPI today, with rents and new dwelling purchase costs up around 3.5% year-on-year. An improvement in the housing market obviously also has knock-on effects for consumer durables such as furniture, white goods, etc. But at the moment, the consumer sector does look a little mixed. Car sales have picked up and look strong, but retail spending remains relatively subdued as a soft labour market has affected household income.
A tumbling Aussie dollar was behind a slightly higher inflation outlook, according to minutes from the central bank's last monetary policy meeting. With the currency having declined 12% last quarter, how do you see this relationship going forward?
On a trade-weighted basis, the Aussie dollar has fallen around 13% since mid-April, and this is a factor which the RBA noted in last week's minutes from the July board meeting. ANZ is expecting the Australian dollar to fall to around 86 cents against the US dollar by the end of next year. Our view is that the RBA would prefer to see the currency fall, which loosens financial conditions, rather than having to keep cutting the cash rate in order to provide stimulus to the economy. A weaker currency can boost growth by weakening import demand, meaning net exports make a positive contribution to growth. This aspect of the change in the currency is fairly quickly realised. Nonetheless, a depreciating currency also puts upward pressure on tradable inflation, and so we think the RBA would have preferred today to have seen slightly weaker non-tradable inflation in order to keep inflation contained within its 2 to 3% target band.
Zoe, thank you very much. For more price action info on the Aussie dollar, click back to Dukascopy TV for my commodities currency themed Targets in Focus interview. Goodbye for now.